Welcome to Wall Street to Bay Street in this edition of Stock of the Week. Actually, it's not going to be Stock of the Week. It's going to be a quick market update to discuss where we are. We haven't had a Stock of the Week for a couple of weeks, primarily because the market has changed its stripes and is now in a downtrend. You can look over the last 13 days or so. We've had a significant downtrend moving in the market. This is a picture of the Dow, the YM, the futures market, with respect to that. And you can see that the nature of the market, this is on a daily basis, has changed remarkably negative. Down here we've had the waves turn negative, both the blue wave and the white wave here. And the Dow is approaching its 200-day moving average. Now, the Dow is much stronger than the NASDAQ. If we bring up the NASDAQ, bring up the Qs here, you can see the NASDAQ has really been taken out to the woodshed, and last week crossed below and stayed below, significantly below its 200-day moving average. This is not a good sign for the market, as the NASDAQ led, a lot of the NASDAQ stocks led on the way up, and it looks like they may lead on the way down. Now, what is interesting about this is that it just undercut its low from, March 13th, I believe? March 16th. And so it just undercut its low from March 16th. So we had anticipated some support around this area right here. But after that, we'll see how the market does. But we expect a bounce over the next week or so. But if we don't get that bounce, it could be some significant downside. Now, one of the stocks that we're looking at with respect to this is, before we go into Apple, let's talk about the stock of the week. Generally speaking, we look for our stocks, we look for strong stocks when we purchase them for a 20% upside move with an 8% downside target, giving us a potential win-loss rate of 2.5 to 1. Now, with the market in a downtrend, we are not going to be picking any upside stocks until the market sentiment has changed and we're moving up again. What we will do is we may focus on stocks for the downside, but our parameters for those are a little bit tighter. What we generally will do is have a 2% stop and a 5% target. Still the 2.5 risk-reward ratio, but we'll tighten our stops for any upside movement. Now let's take a look at Apple here. As we talked about the NASDAQ being weak, Apple too itself broke below the 200-day moving average. You can see early last week it came down to its 200-day moving average and had a significant bounce. But even that bounce didn't last, and it's been weak the last 3 days, and weaker again this morning. So if we take a look here, what I find interesting about Apple is it is trading at a multiple of about 12 times earnings. Now, leading stocks that are world-beating, generally do not trade at 12 times earnings. So is the market telling us that this has potentially peaked and it's on its way down? That may be the case. Recent news over last week has both Apple and Google with its Android phone taking market share over the world. There goes the market. Taking market share over the world. Sorry about that, folks. As live trading has just started here. And RIM and Nokia have been taken out to the woodshed, with Google and Apple taking over significant market share. So any bounces back here, back to this, say this, there's a reversion band here that we use, back to the 329 level, or even up to the 337 level, would be excellent shorting opportunities. I don't anticipate we'll get an opportunity back to 337, but we might get up to somewhere halfway between here, say in the 333 level. Anything in that range we think is a shortable, and you're able to short Apple. Google is another stock that is very, very weak. If you take here in the daily chart, it's crossed below its 200-day moving average a long time ago, back on April 15th, and has since had bounces back up to the reversion band, but continually dropped back down again. So we look for Google to remain weak, even though they're, quote, winning, end quote. the smartphone markets, this is very telling and saying that the market could get much, much weaker. Now, the strongest group in the market these days has been the managed healthcare system and a lot of the healthcare companies in general, biotechs, etc. So you've seen market strength. This is Humana and Aetna. So this is an indication that people are moving to much safer areas, and a lot of the high flyers are not high flyers anymore. So keep an eye out for how the market is moving. It looks like we're in a correction. How significant that will be is yet to be determined. Last time QE ended, we had an almost 20% correction. I think it was 18.7 or somewhere along that line. And QE is ending at the end of this month, so we'll see where things end up. We also have the situation in Europe with Greece and Ireland and Portugal, and kicking the can down the road further there. So we'll see what happens, but stay tuned. Over the next little while, we'll probably be concentrating on short positions with much tighter targets and stops. Good luck, good trading, and hope it helps.